Yo, what's up everybody? It's Jack and welcome back to the channel. Today, we're diving deep into the world of finance. And no, we're not talking about picking meme stocks or chasing the latest crypto craze. We're talking about the fundamentals, the building blocks of how companies work, shareholders and stockholders. You hear these terms thrown around all the time, but what do they actually mean? Are they just fancy synonyms or is there a real difference? And more importantly, why should you even care? Whether you're an aspiring entrepreneur, a seasoned investor, or just someone who wants to understand the business world a little better, knowing the ins and outs of shareholders and stockholders is absolutely crucial. So buckle up, hit that like button to unlock the secrets of the financial world, and let's get started. Alright, let's break down these terms. Shareholders and stockholders, they sound pretty similar, right? And to be honest, most of the time people use them interchangeably, but like that time you thought you were buying a brand new Tesla, and it turned out to be a used Toyota, the devil is in the details. Here's the deal, a shareholder is anyone who owns shares in a company. That's it, they've got a piece of the pie, whether it's a tiny sliver or a giant slice. Now a stockholder is a specific type of shareholder, they own stock in a corporation. Think of it this way, all squares are rectangles, but not all rectangles are squares, right? So if you own stock in Apple, congratulations, you're both a shareholder and a stockholder. But if you invest in your friend's killer kombucha startup, which is structured as a private company, you're a shareholder, but not a stockholder. Knowing the distinction between shareholders and stockholders can also help you better understand a company's structure and how it operates. It's like reading the fine print. You might not always enjoy it, but it's crucial for making informed decisions. Now that we've tackled the basics, let's talk about the different types of shares you can own. It's like choosing your character in a video game. Each one comes with its own unique set of powers and limitations. Common shares are the default setting of the stock market. They come with voting rights and potential dividends, but if the company fails, common shareholders are last to get paid. Preferred shares are like VIP tickets, priority dividends but no voting rights. Choose based on your investment goals and risk tolerance. Okay, so you've got your head wrapped around the different types of shares, but here's the thing. Owning stock isn't just about collecting dividends and watching your portfolio grow. It also comes with a whole set of legal rights and financial implications that you need to be aware of. Let's start with the good stuff. As a shareholder, you've got voting rights, remember? That means you get to vote on major company decisions like whether to merge with another company or elect new members to the board of directors. Then there are the dividends. Companies that are doing well financially might decide to share their profits with shareholders in the form of dividends. And while dividends aren't guaranteed, companies can choose to reinvest their profits or save for a rainy day. They can be a great source of passive income for investors. And here's a big one: limited liability. This means that as a shareholder, your liability is generally limited to the amount you've invested. So if the company goes bankrupt or gets sued, your personal assets are protected. But hold on, it's not all sunshine and rainbows. Owning stock also comes with responsibilities, and one of the biggest ones is taxes. Dividends are taxed as income, so you'll need to factor that into your calculations. And if you sell your shares for a profit, you'll owe capital gains taxes. It's like paying your dues for being a successful investor, so always keep the legal and financial implications in mind when investing. Now that we've got the basics out of the way, let's talk strategy. Whether you're a seasoned investor with a diversified portfolio, or just starting out with a few $100, understanding shareholder dynamics can make a world of difference. First things first, diversification. It's like the golden rule of investing. Don't put all your eggs in one basket, or in this case, all your money in one stock. Instead, spread your investments across different industries, sectors, and asset classes. Next up, think long-term. The stock market is a marathon, not a sprint. Don't get caught up in the hype of short-term fluctuations. Instead, focus on finding solid companies with strong fundamentals, and hold on to those investments for the long haul. And of course, manage your risk. The stock market can be volatile, and even the most experienced investors can lose money. That's why it's crucial to have a risk management strategy in place. Set stop-loss orders to limit your potential losses, rebalance your portfolio regularly, and don't be afraid to take profits when you're up. Smart investing is all about strategy and discipline. Alright, let's talk about something that most people don't even realize they can do: shareholder activism. It's not just about passively owning stock, it's about actually using your power as a shareholder to influence the companies you're invested in. Think of it like this. You're not just a customer at a restaurant, you're a part owner. You have a say in how the business is run, what's on the menu, and even who's cooking in the kitchen. Shareholder activism can take many forms, from voting on proposals at shareholder meetings to engaging with management on social and environmental issues. One of the most powerful tools in a shareholder activist's arsenal is proxy voting. Every year, companies hold shareholder meetings where they vote on important matters like electing board members, approving mergers, and deciding on executive compensation. As a shareholder, you have the right to vote on these proposals, either in person or by proxy. But here's the thing, most people don't even bother to vote their proxies. But here's the truth, shareholder votes can and do make a difference. Now let's flip the script and talk to the entrepreneurs out there. If you're building a business, understanding shareholders and stockholders isn't just some abstract concept, it's crucial for your success. It's about bringing on investors, structuring your company, and ultimately, achieving your business goals. First and foremost, attracting investors. When you're starting out, you're probably bootstrapping it, working long hours, pouring your heart and soul into your business, but at some point, you're going to need outside capital to really scale your business. That's where investors come in. Investors are looking for a return on their investment, and that means understanding how your company is structured and what's in it for them. Are you offering common shares or preferred shares? What are the voting rights associated with each class of stock? How much equity are you willing to give up in exchange for funding? Then there's the balance between control and capital. It's a delicate dance that every entrepreneur has to navigate. On the one hand, you need capital to grow your business. But on the other hand, you don't want to give up so much equity that you lose control of your company. It's about finding that sweet spot, bringing on investors who share your vision and values while still maintaining enough control to steer the ship. Let's wrap things up by answering some of the most frequently asked questions about shareholders and stockholders. First up, can shareholders lose more money than they invest? This is a big one, and the answer is generally no. Remember limited liability? That magical shield protects your personal assets from business debts and lawsuits. So even if the company goes bankrupt, the most you can lose is the amount you initially invested. Next, do LLCs have shareholders? Great question. LLCs are a different breed. Instead of shareholders, they have members. LLCs offer a lot of flexibility, especially for small businesses, and their ownership structure is just one example of that. And finally, are stockholders entitled to dividends? This is a common misconception. While dividends can be a nice bonus, they're not guaranteed. It's up to the company's board of directors to decide whether to pay dividends, how much to pay, and when to pay them. So, there you have it, the lowdown on shareholders and stockholders. We've covered a lot of ground today, from the basics of ownership to the intricacies of shareholder activism. But the key takeaway here is that knowledge is power. The more you understand about the inner workings of businesses and investments, the better equipped you'll be to make informed decisions and achieve your financial goals. Whether you're an aspiring investor, a seasoned entrepreneur, or just someone who wants to level up their financial literacy, remember that this is a journey, not a destination. Keep learning, keep asking questions, and keep striving to expand your knowledge. And hey, while you're at it, don't forget to hit that subscribe button and ring the notification bell so you don't miss out on future videos. Now go out there and make some smart financial moves. Whether you're an investor, a business owner, or just curious about corporate dynamics, understanding the difference between shareholders and stockholders is a game changer. Don't forget to like, subscribe, and hit the bell icon for more insights into business and investing.